Welcome to our International Financial Management course. Today we will talk about the gold standard. Let's begin. The gold standard was a monetary system in which a country's currency value was directly linked to a specific fixed amount of gold, ensuring stability in monetary value. This system established a fixed exchange rate that effectively governed international trade and finance throughout much of the 19th and early 20th centuries, reducing exchange rate volatility. What is the gold standard? In this section, we define and explore the fundamentals of this important monetary system. Under the gold standard, governments committed to exchange paper money for a fixed amount of gold upon demand, guaranteeing convertibility. For example, in the United States before 1933, citizens could exchange $20.67 for exactly 1 ounce of gold at the Treasury. Similarly, in Britain before 1931, 4.25 pounds was equivalent to 1 ounce of gold, maintaining this fixed parity. This system significantly constrained governments because the money supply was directly tied to and limited by their available gold reserves. Historical background. Here we trace the evolution of the gold standard through key historical periods. The classical gold standard, spanning from the 1870s to 1914, featured major countries like the UK, US, and Germany pegging their currencies directly to gold. This era promoted robust international trade by ensuring fixed exchange rates, for instance, where 1 pound equaled $4.86 before World War I. During the interwar period from 1919 to 1939, countries attempted to return to the gold standard after World War I, but these efforts largely failed due to economic instability. Specifically, Britain repegged the pound to gold in 1925, but was forced to abandon it in 1931, while the U.S. left the domestic gold standard in 1933 under President Franklin D. Roosevelt. After World War II, the Bretton Woods system, established in 1944, positioned the U.S. dollar as the central reserve currency, which was convertible to gold at a rate of $35 per ounce. Other major currencies, such as the pound and yen, were pegged to the U.S. dollar within narrow bands, and this framework led to the creation of key institutions like the IMF and World Bank. The end of the system. This chapter examines the events leading to the collapse of the gold standard. The Smithsonian Agreement in 1971 came after the Nixon Shock, when President Nixon suspended the convertibility of the U.S. dollar into gold in August 1971. This agreement sought to realign exchange rates by devaluing the dollar, setting the gold price at $38 per ounce in a bid to stabilize the system. Nevertheless, the Smithsonian Agreement ultimately failed, paving the way for the modern era of floating exchange rates by 1973, where currencies fluctuate based on market forces. Modern relevance. We now discuss the gold standard's role in today's financial world. Today, no country officially operates under the gold standard, with most currencies functioning as fiat money, backed solely by government decree and trust. That said, central banks around the world, including those in the US, Germany, Italy, and France, continue to hold significant gold reserves as a hedge against uncertainty. Although gold is no longer legal tender, it still embodies key characteristics of money, serving as a reliable store of value, a medium of exchange in certain contexts, and a unit of account historically. During times of economic crisis, investors flock to gold as a trusted, safe haven asset, and central banks actively diversify their reserves by maintaining substantial gold holdings. Let's wrap up with the lasting impact of the gold standard. The gold standard profoundly shaped international finance for nearly a century, delivering monetary stability through fixed rates, but severely limiting governments' policy flexibility during crises. Its eventual demise ushered in fiat currency systems and floating exchange rates, which now define and dominate our modern global financial landscape. Even though gold is no longer official money, it endures as a crucial financial asset and a timeless symbol of stability amid the fluctuations of our ever-changing economic world. Thank you for watching our lecture on international financial management focusing on the gold standard. See you at the next lecture.